Hello everyone, and welcome to Mercer Capital's webinar, Buy-Sell Agreements, What Estate Planners Need to Know. Our presenters for today's session are Tom Insalaco and Bo Trudeau. Tom Insalaco is a Senior Vice President with Mercer Capital and has been valuing businesses since 2008. He has experience valuing businesses in many different industries and for many different purposes. Bo is a shareholder at Purcell, Flanagan & Hay. He is Florida Bar Board certified in taxation as well as wills, trusts, and estates. Bo's practice focuses on the legal needs of business owners and high net worth individuals. Specifically, he focuses on the areas of estate planning, estate and trust administration, asset protection, taxation, business planning, and the preparation and negotiation of marital agreements for high net worth individuals. You can learn more about their backgrounds and experience in the Resources tab of this webinar. Before we dive in, let's review a few housekeeping details. If you encounter any technical difficulties during the webinar, please notify us using the chat box. To ask our presenters questions, please enter them into the Q&A box. We will address questions at the end of the webinar. To record your attendance for CLE, you must respond to the survey questions that will pop up during the webinar. Finally, don't forget to explore the Resources tab, where we've provided additional helpful materials.
Good afternoon, everyone.
Without further ado,
I'm Tom
turn things over
Insalaco from
to
the
Tom
Gift, Estate, and Income Tax Compliance team at Mercer Capital. And I have with me Bo Trudeau, who's a shareholder at Purcell, Flanagan & Hay in Jacksonville, Florida. And we're excited to have this conversation about buy-sell agreements and how they overlap with estate planning and when buy-sell agreement pricing can be used for estate planning purposes. We're going to discuss a few things today. First, we're going to start with some basics of what a buy-sell agreement is, triggering events, and a few common methods to determine pricing for buy-sell agreements. And then we'll get into, if you're going to use valuation to determine pricing for buy-sell agreements, what elements should be defined in the buy-sell agreement to help the valuation professionals. Then after that, we're going to get into the good stuff. Bo is going to cover, tax code tax consequences of buy-sell transactions, and then he's going to go over in detail the rules that regulate when buy-sell agreement pricing can be used for gift and estate tax values. And then we're going to finish with talking about a couple of examples of when buy-sell agreement pricing failed to be used for estate and gift tax values in some tax cases or tax court cases. So with that, Bo, I don't know if you want to kind of get us started talking a little bit about the basics of what buy-sell agreements are.
Yeah, thank you, Tom. In their nature, buy-sell agreements are fairly simple. They are agreements among owners of businesses, and often the business itself, that establish obligations to purchase and sell business interests. And these agreements get into a bit more specifics, such as establishing triggering events, what gives rise to these purchase and sale obligations, and they can establish pricing as well. And the benefit of a buy-sell agreement is, we're establishing these agreements at a time when no one is under a compulsion to buy or sell. And doing so at that point in time sort of takes away, the economic incentive to, put your finger on the scale one way or the other, whether you're the buyer or the seller. If we flip over to the next slide, we can see some common triggering events for when buy-sell agreements will often apply. And, as a general rule, it's, when someone is, often departing a business. So we've got a business owner who quits, who's no longer going to be working for the company, or conversely is fired from the company. In that case, with many businesses, your role as an owner is tied significantly to your employment with that company as well. So quitting or firing, or even retiring are often appropriate triggering events. Then we have the uncertainties in life. And if you look down at the bottom of the slide, we talk about the D's of buy-sell agreements. So someone becoming disabled, no longer able to work in the business, someone dying. At that point, you're definitely no longer able to work in the business. And these are some of the more common triggering events. The last two on here, divorce and bankruptcy. These are the types of transfers that are ones that often keep my clients up at night. This idea that they may become owners with someone's ex-spouse or someone's bankruptcy trustee. And these types of transfers are ones that will frequently include in a buy-sell agreement, to ensure that, we're keeping the group of owners as, just those persons that people want to be in business with, and, not persons who, may receive transfers of interest as a result of, some very difficult event like divorce or bankruptcy. Tom, you're going to talk about the types of buy-sell agreements.
Yeah, one other comment I have here, though, really quick is I think a lot of people think death first when they think about this, but what we see, and I'm sure, Bo, you see the same thing, is the odds are one of these other items are going to happen before one of the partners passes away. So the other ones are important to think about as well.
Fair point.
Types of buy-sell agreements. So there's a lot of different mechanisms for estimate or getting to the price for a buy-sell agreement. The most common three that we see are fixed price formula agreements and process agreements, which include valuations. So fixed price agreements, typically that's going to be the owners kind of agree on a fixed price, and typically when a agreement is formed, there's going to be a schedule in the agreement that kind of documents the fixed price that the owners all agree to. But what we commonly see here with these types of agreements is that that the owners never actually agree to a price. So we get the organizational documents for the entity, and the schedule is just blank. The other thing, though, is even if the owners do, when they've come to an agreement on a fixed price when they start an agreement, years, they might never update that agreed upon price. So years might pass, and it might be a decade or two later, and a triggering event happens, and you're going to have a transaction at a value that was agreed upon years ago that may not make sense anymore. So it's going to end up being unfair to one of the parties involved. So we do not recommend using fixed price agreements.
Tom, I will frequently inherit buy-sell agreements when I get a new client, and I have yet to find, I call these Schedule A agreements, where you update the price on Schedule A. I have never seen a Schedule A update. I have only seen an initial price determination, and never after that have the clients updated it. And in my experience, this is probably the most common type of agreement I run into. And it's also, the one that most frequently will fail. So it's not a type of agreement that I would ever recommend, the fixed price.
I agree. The disadvantages far outweigh the advantages.
For sure.
The advantage is that it's easy to implement, but so which is why we probably see more of these than anything else. But so then formula agreements, typically, you'll agree on a formula. These are kind of easier to implement as well. But the same issue here applies. Typically it might be a multiple EBITDA or book value. Well, the issue is, the multiple selected to apply to EBITDA, if that's what you're using. Over time, the industry conditions, economic conditions in the company changes. So if you pick, say, a 5 times multiple 10 years ago, maybe that 5 times multiple is not close to representative of a fair market value now. So again, you could end up in a situation where one of the parties feels that they got the worst end of the deal. The other thing is EBITDA. Maybe the agreement might say adjusted EBITDA, or who's calculating the EBITDA, who's calculating the formula. So I think if you are going to use a formula agreement, you want to make sure that how the formula is calculated is very clearly defined. Um, but again, same issue that these are probably not going to be good to use for fixing prices from buy-sell agreements to use for gift and estate tax purposes. So again, I'd kind of defer to evaluation. The third is process agreements, valuation process agreements. So here you have really two general kinds. One is multiple appraiser processes, and then the other is single appraiser processes. I think the multiple appraiser processes seem to be more common, and generally you'll see a couple of appraisers, one representing each side, being brought in, and if they're within a certain percentage, then maybe it's just the average of the two. But if they're not, then a third appraiser is brought in, and then some kind of arrangement, either average of the closest two appraisals, or the third appraiser just determines price will be used to come up to the final definitive price. Obviously, the downsides to these are there's a lot of uncertainty with how long the process is going to take. Is a third appraiser going to be needed? What's the price going to ultimately be? What's the valuation methodology going to be end up being? So there's just a lot of uncertainty here for all the owners involved when a triggering event occurs. So, but I guess,
Tom, I'm not a big fan of the multiple appraiser
yeah.
process.
Mhm.
My experience is that when we have each side hiring their own appraiser, there's always the wink, wink, nudge, nudge. You know which side of the table I'm on,
Yep.
and the appraisals are certainly science based, but they're also an art form as well.
Mhm.
And what ends up happening is naturally the buyer's appraisal favors the buyer and the seller's appraisal favors the seller. And that to me sort of undermines the process of what we're going for. I will always try to steer my clients into some sort of single appraiser methodology, whether it's the two of them agreeing on an appraiser, whether we get a disinterested party to appoint the appraiser. And I'll frequently name myself in agreements or another member of my law firm
Mhm.
to appoint the appraiser. And everyone's going to agree up front that, we're going to, have an independent person select the appraiser. And, that takes a lot of sort of the gamesmanship out of the appraisal process.
Yes. Yes. Yeah. Real quick before I was going to get into single appraiser processes next, but before I do, if there's a third appraiser, typically they can be the determiner, which their price is just definitive, or they could be the judge or mediator, which basically they're deciding between the first two appraisers, or they can be the reconciler, which is some kind of process where either the average of the closest two or average of the three are taken. Oftentimes we see that as the average of the closest two. And the interesting thing about that to think about is if appraiser one and two are significantly apart, and appraiser three, depending on where their value falls, they're right towards the middle of the midpoint of the first two appraisals, there can be, with just a small dollar change in their concluded value, there can be quite a swing in what the average of the two closest would be. You see here, $2 difference, 41% difference in ultimate value. So that's something to be kind of conscious of. But anyway, yeah. So we based on Bo, what you were saying, that's also what we as a firm kind of recommend, and I know a lot of appraisers recommend this. A single appraiser process where you select the appraiser now right at the beginning of when the agreement is made, and ideally have them value the company now. the benefits to this are, you get evaluation done right away. So all the parties involved will see what the methodology is going to look like and have an idea of what the price is going to be. And then everyone also can agree on the appraiser up front, whether it's, the parties picking an appraiser themselves or them picking an attorney like yourself, Bo, and you picking an appraiser. But so, this relieves some uncertainty about how long the process is going to take, pricing and the methodology. So we kind of recommend this as a process.
So
and
Tom,
then-
I am certainly a proponent of using appraisals as our pricing mechanism in buy-sell agreements. To me, it is the appropriate fit for probably 90% plus of businesses. What I struggle with is clients are more than happy to, identify the appraisal as the pricing mechanism for our triggering event. But most of them don't want to pay for the appraisal now. They would rather live with the uncertainty to avoid that immediate cost.
Yeah, well, ideally, we also recommend having the company valued every year so that there's always a recent appraisal. So when a triggering event happens, you already have a price lined up and everything's all set, and there's no uncertainty at all in that regard. But I would say, obviously, pragmatically, for many clients, that the cost to getting an appraisal up front and recurring appraisals might be, a roadblock for them. But if for the attorneys listening, if you have clients who view it as a stress point that there could be when there's a triggering event, there could be uncertainty over what the pricing is going to be or the process is going to look like. We as appraiser, I would recommend talking to the appraiser, because we don't need to do full appraisals every year. We could probably come up with some process where we kind of just do some calculations or something and that'll at least help alleviate some of those stress points for the so I think it's always worth, at least in a conversation with a valuation person. Don't just think that your client's going to balk at the price and just kind of eliminate that as an option. So I'd recommend.
Yeah, that's helpful.
Yeah. All right, so next section, we're going to go through quickly some defining elements of buy-sell agreements. If there is an appraisal process involved, the appraisers coming in to do the valuation, they need a roadmap. We don't want to be making decisions on some of these items ourselves. So there's several things that we kind of recommend being defined. But one, if there's a single appraiser, how do you want the company value to be viewed? So these things should be defined. And then two, if there's multiple appraisers, like Bo was saying earlier, these are all areas that could be disagreed on and both sides could kind of push things to their advantage on these factors. So if they're defined, it at least gives both sides a guideline, so it's more likely they'll kind of line up. But the first one is standard of value. And so the standards of value, typically, fair market value is the big one based on revenue ruling 5960. That's what we recommend using for buy-sell agreements. All appraisers are familiar with that standard: hypothetical buyer, hypothetical seller, no compulsion to buy. Both parties relevant or knowledgeable of all the relevant facts. So I think that's the standard that should pretty much always be used. There's also fair value, but there's different values of fair value under different state laws for shareholder oppression. And then there's also some accounting rule or accounting definitions of what fair value is. So, and those are all different. So if you just say fair value, there could be a little bit of confusion. And then investment value to a specific owner. So, which specific owner, that leaves a lot of subjectivity in the process. So we recommend fair market value be used for standard of value.
And I share that recommendation, Tom. And one thing I would encourage, the other attorneys in the room is, define fair market value, spell it out in the agreement so that, it does provide a clear roadmap to the appraiser and no ambiguity about it.
Yep. The second one is level of value. That I think this might be the most important one. when you're looking at an interest in a business, it could be at a financial control value, which is just the pro rata value per share or per membership interest that everyone would get if you sold the business to a financial buyer. But then you move up a level and you have strategic control value, which is would include synergies, and that's to a specific buyer. And then you move down from financial control value to non-marketable minority level. That's typically with discounts for what we would do for an estate or gift tax valuation for a minority interest. You could see a premium on strategic control if your base financial control value is $100 per share, you could see, a 30 or 40% premium. Alternatively, you could see a 30 or 40% discount. So the difference between strategic control value for an interest and a non-marketable minority level value for an interest could be very significant. So to take uncertainty out of which level appraisers should be valuing at, we recommend defining it. Because obviously, that the seller is going to say strategic. If there's no guidance, the sellers advisors are going to try to angle for it should be some kind of strategic level of value because there could be a sale, and then the buyer is going to say no, it's a minority interest, so there should be discounts. So just lay it out in the agreement so there's no. I think this might be the most important one, but
Yeah, I agree with that, Tom. I see frequently that the value will be defined as, just the fair market value of the stock. And frequently I'm dealing with, third party independent business owners, and they really don't want the fair market value of the stock, which would likely include discounts for lack of marketability, discounts for minority interest, control premiums, those sorts of things. Rather, what they're looking for is, a percentage of the enterprise value.
Yes.
So, this needs to be an absolute point of focus when the agreement is being drafted. What do the owners want? Do they want, just a straight percentage of the enterprise value that we're not going to factor in all these discounts? Or, is it appropriate to take into account these discounts or potential premiums in the value of the interest?
Yep. Yep. So the next one is the as of date, valuation date. Obviously, if someone passes away, the date of death is the date that's going to be used, but there could be a little bit of uncertainty with some of the other triggering events occur on which date it should. So the agreement should kind of define for each major triggering event what date specifically is going to be used.
Yeah, one I would recommend is if you've got a divorce buy-sell agreement, we don't want to use the date of divorce because frequently we want the buy-sell to be triggered well before that.
Yes.
Rather, what I would recommend is the date, either spouse files for divorce.
Yep. And the other thing here is just what is reasonably known or knowable as of the valuation date. You could get into arguments over, each side could say different things were known, or if there's a major acquisition or expansion of the company that's being talked about around the triggering date, the opposite sides could argue over what was known or knowable about that on the valuation date because it could impact value. So I think good documentation by companies to so there's clear proof of what was known or knowable when there's a triggering event is probably helpful, but that probably gets beyond what's going to be in a buy-sell agreement. Then the next thing, element number 4, is qualifications of appraisers. And again, this goes back to the two sides. If the selling side wants a higher value, they might, if there's no terms in the agreement defining who can be qualified to be the appraisers, they might go and get an investment banker that has industry experience, and the investment bankers are commonly looking more at transactions, so they might they tend to come up with a higher, more strategic level of value. So and then also alternatively, the buyer is going to want a lower price, so they might hire someone like me who focuses on a gift and estate tax work and is used to putting discounts on most of our work. I think appraiser experience is much more important, I think, for, determining value for a buy-sell agreement, because there's no actual, well, there's a transaction, but there, I think it's just better to have an appraisal. So in that regard, I think, spelling out which qualifications are needed to be qualified to be the appraiser in the for the buy-sell agreement pricing. That there's the ASA, the American Society of Appraisers, their accredited senior appraiser designation. That's what I have. That requires 5 years at least of full-time valuation experience, and then following USPAP standards for valuations. So I'd recommend that. But there's also the CVA from NACFA and the ABV from AICPA. Those are also commonly held valuation credentials. So I would kind of say, just maybe define who's qualified by, pointing to some of those credentials in your agreement.
Yeah, limiting it to qualifications, I think, can help mitigate a lot of the gamesmanship that might otherwise go on.
Yeah.
So someone, who may just want to hire their CPA,
Yeah.
who they know will, push the number in the direction they'd like to see it head to.
Yeah. Or my brother has an MBA and he's never done valuation before, but I think he's quite, so you want to rule people like that don't actually have appraisal experience out, I think. So, but then the fifth one is appraisal standards. So like I mentioned, uniform standards of professional appraisal practice, USPAP. All ASAs are bound to kind of follow those standards. But then AICPA has some standards for valuation services, and NACFA has some standards as well. So I would just recommend defining, so everyone's playing on this, using the same set of standards to back their work. I would recommend defining, some of these standards should be followed. And then the last thing is it kind of related to the standard of value, the fair market value, and the level of value, but going concern value, the premise of value is what this really is. Going concern is the premise that's mostly used for fair market values, assuming the company is going to be a going concern. The other premise of value is liquidation value. And so I think you want to define this because sometimes one side or the other, if there's two appraiser process, one side or the other might decide to use liquidation value if it benefits their side. So I think you just want to define that it should be, along with fair market value, it should be going concern value. The last thing is funding mechanisms that should be defined. That's not exactly a valuation thing, but it's kind of tied to it. So, well, I don't know if you want to talk briefly about some of the major funding methods.
Yeah, the life insurance advisors are frequently the referral sources for buy-sell agreements. They do a good job of educating their clients on, the risks of one owner dying and what can happen as a result of that. So it's not uncommon that we will be looking specifically at using life insurance to fund a buy-sell agreement in the event of death. Even in those scenarios where we know we're getting life insurance, I try not to make the assumption that life insurance will always be available. It may term out. It may, someone may not be insurable. And so I will always include some sort of structured payments to serve as a backstop. And in some cases, serve as the primary mechanism for funding. Disability insurance is also something that we look at to fund buy-sell agreements, and specifically the disability buyout. I've looked at it plenty. Admittedly, I have never had a client actually purchase disability insurance to fund a buy-sell agreement.
Yeah.
So, it is a tool that's available. I will, and then last, this final bullet, I will frequently see buy-sell agreements that say we're going to use a different valuation methodology if this is a buy-sell for divorce or bankruptcy. we don't want to pay the divorcing spouse the same price we would pay to, the owner's family in the event of death. Or we don't want to pay, creditors or the bankruptcy trustee the same price we might pay in other circumstances. And I'm very wary about the enforceability of these types of provisions. I've seen, we're going to use book value in those circumstances. And I think you run the risk that if you're going to reduce the payments for certain triggers, that, a matrimonial judge or a bankruptcy judge might reject your buy-sell agreement. So I generally steer clients away from trying to reduce the payout for certain purchasers. Maybe we factor in discounts for lack of marketability or minority interest in those circumstances when we might not otherwise. So those types of things are things I talk about with clients. But I discourage clients from getting too aggressive with reducing the payments for divorcing spouses and bankruptcy buy-sells.
Yeah. One more thing from a valuation standpoint on life insurance being used to fund a buyout and a death. There's two ways that valuation people could look at the life insurance. It could be viewed as a funding vehicle. So like in this scenario, let's say you have a $10 million company and two owners own 50-50, $5 million each. There's $5 million of life insurance. So if it's used as a funding vehicle, the value would just be $5 million for the 50% owner. We would kind of disregard because the proceeds from the insurance are going to come in and then they're going to be paid out to the estate. So for the buyout price and if we're looking at it as a funding vehicle, we would ignore that. The second way is looking at it as a corporate asset. In that case, if you have a $10 million company, again, the $5 million proceeds from life insurance would flow into the company. It would be viewed as a corporate asset. So you'd have a $15 million value for the company. So then you have a $7.5 million value for each of the 50-50 owners. And then the $5 million would be used to pay out the estate, and the other $2.5 million would need to be funded some other way. The Connelly case kind of we'll talk about that later, but it kind of pointed to using corporate-owned life insurance method. But the point of this is if you have a buy-sell agreement and it's a three appraiser method, both sides are going to possibly view the life insurance proceeds differently based on which side they're on. So then if I get brought in as the third appraiser and it's not spelled out which way the buyout price should consider life insurance in the valuation, then I'm going to have to make the decision. Should I view it as a corporate asset or a funding vehicle? And I don't want to be in that position as an appraiser to decide that. So that's something that I think should also be very clearly spelled out in the agreement. But with that, so Bo, you're going to talk about tax code considerations next.
Yeah. So there's kind of two general types of buy-sells. One is a cross purchase. This is the circumstance where Tom and I are owners of a business. I pass away and Tom gets the opportunity to buy my interest in the business. And the second type is a redemptive buy-sell agreement, a redemption. In that circumstance, when I pass away, the company purchased my interest in the business. And Tom still ends up as the 100% shareholder. But what we see is that the cross purchase and the redemption can have very different tax consequences. There is a third type of buy-sell agreement, which is the model of agreement I use in almost all scenarios, and that's the hybrid or wait and see. And that gives us basically the option to use either a cross purchase or a redemption. And usually either the other owner is given the option first or the company is given the option first. And then if that option isn't exercised, the other party has the option. So there's an ordering rule to it. Excuse me. So the next slides are going to kind of illustrate some of the tax consequences of cross purchase or buy sell. And Tom, if we could go back real quick to that last slide, let me just lay out the facts here. We've got, business worth $10 million. It's father and son, each owning 50% interest, and they have a $2 million basis in their stock in the company. And well, let me just, preface this with these are oversimplified examples. But I think these examples do a good job of sort of highlighting how cross purchase and redemption can have very disparate results from a tax perspective. So on the next slide, you'll see we've illustrated father passing away. And, there's, when someone dies owning a capital asset, we get a nice tax benefit, a benefit that's frequently referred to as a tax loophole, but that's stepped up basis. And basically, that's the elimination of capital gains at death. So father previously had a $2 million basis in his stock. The company was worth $10 million, so father's pro rata interest is $5 million. But let's assume we're going to factor in discounts for lack of control, lack of marketability. These will be an aggregate 20% discount. So the fair market value of father's stock is $4 million. So what you'll see is that the basis of father's interest increased from $2 million to $4 million. So if you go to the next slide, Tom, now we'll show how cross purchase works. So specifically, father's estate is going to sell the stock to son for $5 million. And so, what you'll notice here is that this buy-sell agreement requires the purchase price based on a pro rata share of the enterprise value. If we had required it to be, the fair market value of the stock itself, factoring in discounts for minority interest and lack of control, we might have had a $4 million value. But here, the agreement establishes a $5 million value. So the stock passes to son. He's now the 100% owner, and $5 million passes to father's estate. Tom, if you can proceed, there we go. So what we know from a cross purchase is that the transaction will be treated as a sale for tax purposes. And when we go to the redemption example, we'll talk about scenarios where it could be treated as a dividend. So that might be the alternative. But here, we have father's estate paying a tax of $238,000. So, $1 million of gain, and we've got our maximum combined capital gains and net investment income tax rate of 23.8%. And so what we see, the ultimate tax consequences of this transaction is that, we've got net proceeds to father's estate of about $4,762,000. That's the sale proceeds minus the tax. And then son takes a basis in the stock he has acquired from his father of $5 million. Added to his original basis of $2 million, son now has $7 million of basis in his stock. So this is a pretty good example. Fairly low tax because of stepped up basis, and son having significant basis in the stock of the company after the transaction. So next we'll go to the redemptive buy-sell agreement. So in this case, father's estate transfers the stock back to the company, and then father takes $5 million, again, using the pro rata value of the enterprise value of the company to determine the pricing. At the end of the day, son still has his stock, but his stock now represents 100% interest in the company. So what are the tax consequences? So if this is treated as a sale, the tax consequences are the same as what we saw in the cross purchase. However, anytime we have a redemption, we have the transfer of money from the company to an owner, which can often be treated as a dividend. And so if it's a dividend, the tax consequences are very different. Instead of, capital gains treatment, the full amount of the purchase price, or pardon me, yeah, the purchase price that's paid to father's estate is taxable. So we don't get the offset for basis. You'll also notice from the parenthetical that we don't get installment sale treatment. So if that $5 million was paid, $1 million per year over 5 years, it may not benefit from deferring the tax over that duration. Son's basis in the stock remains $2 million as well. So, son didn't buy dad's stock.
Yeah,
Rather,
he doesn't
that
look
stock was turned into the company.
He doesn't look
Sorry,
happy.
Tom?
I said he doesn't look happy.
Yeah, so Chat GPT helped me with my little stick figures here. You'll see Son has a frowny face because he's only got $2 million basis in his stock. Also, if Son is the only beneficiary of father's estate, the net proceeds he's taking from the purchase and sale is significantly reduced. We went from 238,000 of tax to over $1 million of tax.
Yeah.
So you can see that the redemption will frequently or could potentially result in much more onerous tax consequences to the family in this circumstance.
Yeah.
And here we have the comparison of the two transactions. And again, these are very oversimplified examples, but I think they do highlight the ways that the different types of structures can be treated. So if I'm, funding a buy-sell agreement, we know we're getting life insurance. I am usually looking at the cross-purchase or something that we're not going to get into today, but partnership-owned life insurance to serve as my mechanism, because the redemption in most circumstances will result in a worse tax result for the parties.
Mm-hmm.
So, Tom, I'm going to kind of zip through this because I don't know that we want to get too bogged down on sale or dividend treatment when we've got a redemption. So there's tests that you can meet. And, in the event of death, it's usually not too difficult to meet one of these tests and to qualify for sale treatment. So I don't want that, redemption example to be, too inflammatory. But, you need to, if you are designing a redemptive buy-sell agreement, and, sometimes there's good reasons to do so. Maybe that's where the cash is available. But if you need to make sure that the potential purchase at death or another triggering event is going to get sale or exchange treatment and not be treated as a dividend that potentially gives rise to greater tax. Not essentially equivalent to a dividend. These are basically meaningful reductions of a shareholder's interest in the company. And I'll let our viewers review these slides at their leisure. Tom, let's go to test 2. Substantially disproportionate. These are 4 specific tests that you've got to meet all the requirements. One thing to note is, family attribution rules apply to these. So be careful of those. Test number 3, complete termination of interest. Again, we have family attribution rules. So, there is the ability to mitigate those rules with family attribution waiver. Test number 4, we're doing a partial liquidation of the company, eliminating one area of the business, for example. Test number 5, the 303 redemption. We are redeeming some of the business interests so that the estate can get cash to pay the estate tax, and that's frequently a very good tool to use.
Yep.
To
Yeah. Well, I was just gonna say, Bo, do we want to move along to these sections of the tax code?
Yeah. So fixing estate tax values is a huge benefit that you can get with a buy-sell agreement. Essentially, you can have your buy-sell agreement dictate or safe harbor the value with the IRS for estate tax purposes, but there's specific requirements that have to be met. The first of those requirements is listed under 2031 of the regs. And I'm not going to read this whole regulation to you. And in fact, I think it's summarized on the next slide,
Yep.
which is, it's referred to as the Wilson Loan Rule, which is 2 cases from the 1930s that, articulated the 4 requirements. And just to run through them briefly, number 1, there's got to be an obligation to sell. Number 2, there's got to be a fixed and determinable price. Number 3, preclude lifetime transfers at a price in excess of the agreement. And 3, not a device to transfer the interest to family effectively for inadequate consideration. So 2031 was our only body of law on this until the 1990s, when 2703 was enacted as part of Chapter 14. And we got some additional requirements. And there's 3 requirements from Chapter 14 or 2703, but one of these overlaps. And so I think of it as 2 additional requirements to be met. The first one is it's got to be a bona fide business arrangement. So that's one of the new requirements. Second is not a device. So that's our requirement that overlaps. And then third, the comparability test. And this, to me, is the big one. The agreement needs to be comparable to similar arrangements entered into by unrelated parties dealing at arm's length. So in total, we get 6 requirements. We still have the 4 requirements from 2031, and then 2703 adds requirements 5 and 6. Tom, go to the next slide.
Yep.
So, you are deemed to meet the 2703 requirements if more than 50% of the company is owned by individuals who are not members of the transferor's family. And remember, this is another case in which we have broad attribution rules apply. So when you're looking to calculate that 50% interest or more than 50% interest, we have to be mindful of that. And so what ends up happening is we have different sets of requirements between a business that's primarily owned and controlled by unrelated parties versus a family-owned business.
Hey, Paul, quick question. What constitutes a family member? I mean, how closely do you have to be related for it to fit under that rule?
Yeah, the attribution rules are pretty broad. I'm I'm not sure offhand how far it goes. I've got to go look at it every time I take a look at this. And but yeah, the traditional close family members are what you would frequently think of.
But
You know,
there
siblings,
is,
children.
yeah, in the code there is, it's defined who qualifies and who doesn't though. Okay, gotcha.
Correct. It's fairly mechanical.
Yeah, so it's not, there's no subjectivity. Got it.
Yep. So you know if you have a transferor who doesn't own 50% of the business, either directly or through attribution, then the requirements are fairly straightforward. Obligation to sell, fixed and determinable price, and precluding lifetime transfers at a price in excess of the agreement price. Conversely, if we've got a transferor who owns more than 50% of the business, either directly or with family, then we've got the three additional requirements that have to be met: not a device, bona fide business arrangement, and the most difficult one, which is comparability.
Yeah.
So going through each of these requirements, the obligation to sell is a pretty easy one to meet. And in fact, we don't have to, mandate that there's a purchase and sale in the event of death. Rather, an offer, a mandatory offer by the estate of the decedent is sufficient to establish and to meet this first requirement. So second requirement is a determinable price. And I would tell you that this is generally an easy requirement to meet. And I sort of viewed this as one that, you couldn't really run afoul of. You just have to establish some sort of price or pricing mechanism in the agreement. But what we'll see from the Connelly case is this determinability test wasn't met, at least, as articulated in the Eighth Circuit opinion. The third requirement, restrictions on lifetime transfers. So, we can have an absolute prohibition on lifetime transfers. Say no one's allowed to transfer their interest. We can also have a right of first refusal, and that's something I will frequently include in a buy-sell agreement. You can't transfer it to a third party without offering it to the other owners, or maybe to a controlling owner. You'll see the private letter ruling 9133001. They had a prohibition against transfers unless it was consented to by all shareholders. And the IRS ruled that this was not a sufficient restriction on lifetime transfers. I'm not sure this was the correct result. I mean, as a practical matter, if all the other shareholders consent, you can amend any agreement anyways. So this seems like it should have been sufficient to me, but clearly the IRS disagreed with this. And then you've got the estate of Hall, which permitted transfers to family members. And, the IRS argued that, this arguably permitted, transfers at a price in excess of the agreement price because there was no constraint on what the price would be. The tax court rejected this argument, basically saying, there was never a transfer during lifetime in excess of the agreement price, nor was it likely to occur. That said, I don't think you want to rely on the Hall case. Frequently I'll include family members as permitted transferees in agreements, but they're only permitted to receive their interests through gift or, with a cap, for example, on, the price that can be paid. It can't be more than the agreement price. So fourth requirement, the device test. This is the don't play games with us. You'll see we've got some indicia of a device. A party's in poor health, and they decide at that point they're going to execute a buy-sell agreement. Also, the failure of parties to honor a buy-sell agreement in previous instances. And this is something we see frequently with the IRS. Why should we, the IRS, be bound by an agreement price if you, the taxpayer, and your other business owners aren't going to honor the agreement? And this is something we see as well in the Connelly case. Bonafide business arrangement. Yep, you can go ahead to the next slide, Tom.
Gotcha.
The existence of unrelated parties. Tom and I are in a business together, and Tom doesn't want to be in business with my wife if I pass away. This is usually a bona fide business arrangement. Similarly, if it's all family members, preserving that family control has been interpreted as a valid business arrangement. So this isn't too difficult of a test as well.
Yeah.
The real test, I think, that we get from 2703 is comparability. It's got to be comparable to a similar arrangement by parties in an arm's length transaction. And to me, this is probably the biggest reason I use the requirement of a business appraisal in my buy-sell agreements, particularly if I'm trying to fix estate tax values. As a practical matter, it strikes me as nearly impossible to otherwise get there. And so if fixing values is important, I think the appraisal methodology is really the only path. On the next slide, I think we go through some of the cases that have interpreted comparability. First we have the Lauder case, and this is Estee Lauder, the cosmetic company. They had a buy-sell agreement that used book value to determine the value of the shares, and the tax court rejected that as a sufficient methodology. One, there was no relationship whatsoever to fair market value, and two, there was evidence of cosmetic companies being traded at much higher prices. We have the Blunt case. Here they had a formula based methodology, 4 times earnings, and the tax court held that there was no evidence that similar arrangements entered into by parties at arm's length. So 2 negative cases. But last we have the Omley case, and the Omley case is a favorable one. And here the comparability requirement was met because a valuation expert was used to determine the stock price, and they determined that price based on an analysis of other similar businesses in that region. The price was negotiated, and the price was approved by the conservator for the estate of the decedent, or pardon me.
Yeah.
And so, we see that we've got a negotiated agreement, and we've got a valuation methodology being used to establish the price.
Yeah. But so the comparability requirement, that's specifically for businesses that are more than 50% owned by family members, right? So if you're a bunch of non-related parties that own a business, you don't have to meet that requirement.
Yeah, I mean, Tom, if it's you, me, and my brother in business together, and we're all 1/3 owners of a business, you pass away, the comparability requirement doesn't have to be met.
Yeah.
Because you would be the transferor and you own less than 50%. I pass away, the comparability requirement has to be met because I'm an owner of the business, and through attribution, I own more than 60%, or pardon me, 50% of the stock.
Yeah. All right, let's move on. We have we have about 10 minutes left, so we're going to go through two recent cases, Connelly, which everyone's familiar with probably already, and then the Huffman case. Bo, if you want to talk about the Connelly case.
Yeah. Yeah. So, it's rare that we get tax decisions from the United States Supreme Court, but this is one of those. And, the Connelly case is an important one. So here we had the Crown C Corporation owned by two brothers, Michael and Thomas. Michael was the 77% owner. Thomas was the 23% owner, and they entered into a buy-sell agreement, giving each other the right to buy the shares, and if the surviving brother declined, the company had the right to redeem the shares. So this was a hybrid buy-sell agreement. And they had two mechanisms to determine the purchase price. One, they had the certificate of agreed value, or our notorious Schedule A to the agreement that would be updated every year. Or if they failed to do that, there was the requirement of two or more appraisals. They also funded the buy-sell agreement. The company purchased $3.5 million of life insurance on each brother. Michael died in 2013, and there was an agreement between Thomas, the surviving brother, and Michael's estate on a redemption price for the stock of $3 million. I think it's important to note that the executor or personal representative of Michael's estate was also Thomas. So the arm's length nature of the transaction is certainly something that can be questioned in this scenario. The estate reported the agreed upon $3 million purchase price as the value of Michael's stock for estate tax purposes. So the IRS came in, audited Michael's estate tax return, and determined the value was not $3 million, but it was actually $5.3 million. And Michael's estate paid the tax deficiency and filed suit for refund. The district court awarded summary judgment for the IRS. One, they determined that the agreement did not fix the value for estate tax purposes. And two, they determined that the value, or pardon me, the proceeds of the life insurance, the $3.5 million that was paid to Crown C Corporation, had to be included in determining the value of the company. The estate appealed, and the Eighth Circuit followed suit and upheld the decision of the district court. And one, they held that the agreement did not establish a fixed and determinable price. So again, we talked about that determinability test. Here they failed the determinability test. So even though they had multiple mechanisms in the agreement to figure out a purchase price, because Thomas, on both sides of the transaction, did not, have a Schedule A, did not use the appraisal process, whatever agreement he came up with, it didn't really have any sort of tie to the actual document itself. So the IRS, the Eighth Circuit affirmed that there was no fixed and determinable price. They also affirmed the decision that the $3.5 million of life insurance should be included in determining the value of Crown C. And when the Eighth Circuit ruled, they created a split in the circuit. So, previously we had the Blunt decision, which was also referenced earlier, for fixing value, as one of the cases that said you don't have to include the value of life insurance in the value of a company in determining the value for estate tax purposes. And the logic of the Blunt case was basically, yes, we've got this life insurance that's coming into the company, but it should be offset by the obligation that the company has to use that life insurance to purchase the stock. The split in the circuit is what caused this issue to be brought before the United States Supreme Court. And Clarence Thomas was the author of the opinion for what seems to be an unlikely event these days, which is a unanimous opinion of the United States Supreme Court. The opinion did not go into fixing values for estate tax purposes. Rather, it focused solely on the issue of, is life insurance included in the value of a company for estate tax purposes if it's used to fund a redemptive buy-sell agreement? And the answer was yes. And Thomas provided a simple redemption example that illustrated how the value of the company is increased when it receives life insurance. Thomas also noted that these guys could have just done a cross purchase if they didn't want this result. And so there's a few takeaways from the Connelly case. The most important one is respect the agreement. If you want the IRS to respect your agreement, you're going to have to do so as well. So that's just kind of a basic tax principle. 2, don't do a Schedule A. It's simple on the front end, but it doesn't really accomplish the objective that you're trying to accomplish. And then 3, if planning for estate tax purposes is important to you, the redemptive buy-sell agreement is probably not going to be the best option. Rather, you should be thinking about a cross purchase, or if you've got a situation where you've got a lot of different owners and buying multiple life insurance policies on every owner is unwieldy, then consider a partnership-owned life insurance. And we're not going into detail on partnership-owned life insurance today, but that's something that needs to be carefully drafted as well. And if anyone has any questions on it, I'm happy to answer those.
Yep. All right. So the second case we're going to go over kind of gets right into that comparability test that Bo was talking about, which applies to businesses that are more than 50% owned by family members. This was also shortly after the Connelly case, so I think it might have gotten overshadowed. I think a lot of people are not as familiar with this one, but it revolved around a company called Infinity Aerospace, which was formerly known as Dukes, so we'll refer to it as Dukes as we talk about it. Founded back in the 1950s in California, and Lloyd Huffman and his wife Patricia both worked for the company as engineer and bookkeeper, respectively. In 1970, Lloyd was named president of the company and acquired 113,000 shares. And then him and his wife formed the Huffman Family Trust in 1979 and moved the shares over to the trust, and then also purchased another 5,000 shares for the trust. There's a lot more facts to this case, but I'm kind of just going through high level because we're running out of time. So I'd recommend reading the case. There's other things going on too. But anyway, so in 1987, this is where Lloyd and Patricia's son Chet became involved. Lloyd was into car racing and he had a nearly fatal accident. So his son Chet took over as the CEO and was issued 5,000 shares, which 5,000 shares at the time was about just a little bit under 1% of the total outstanding. Chet's 2 older brothers were also working for the business, but they're kind of not that important to this story. Well, not as important. 1990, Lloyd and the biggest shareholder of the company, Robert Barneson, entered into a right to purchase agreement where Lloyd had the right to purchase Robert's shares at his death or for nothing, a price to not exceed $2 per share. He also had a right of first refusal. So then in 1993, Lloyd assigned his rights to that Barneson right to purchase agreement to Chet, and Chet purchased Barneson shares for $150,000, and that made Chet 43.7% owner. That purchase price of $150,000 for the 322 shares amounted to, I think, 40 something cents per share. So it was well below the $2 per share. 1993, Chet entered into two new RPT agreements, right to purchase agreements, one with the Huffman family trust with his parents, basically, and then the other with an entity called Duke's Research Manufacturing, Inc., which was an entity that was wholly owned by his mother, Patricia. And so he had the two agreements with those two entities to purchase all their shares in Duke's for a sum of $2 and other good and valuable consideration. The other good and valuable consideration is going to be important. So the other factors, so Chet took compensation of between $65,000 and $85,000 per year from the 1987 when he took over as CEO until 2006. There was only one other executive of the company, and they were being paid about $250,000 annually. So Chet was clearly taking a below market rate for his services. The company grew significantly under Chet's leadership. The case, if you read the opinion, it goes into all the details of everything Chet did, but he played a significant role in growing the company from $5 million in revenues in the early 90s to $28 million in 2006. And during this time also, Chet's brothers and other family members formed various other business entities to lease employees and manufacturing equipment back to the company. So there was a bunch of related entities. But in the early 2000s, Chet and the company received several offers to buy the company from outsiders, but the company wasn't for sale, so they turned them all down. But then in 2007, the company received an offer from a Korean company, Hanwha, for between 85 and 105 million. They received a memorandum of understanding pending, diligence findings, and part of that a memorandum of understanding was that Chet was going to consolidate all those related entities and consolidate ownership. So in 2007, Chet made those moves, and he exercised his option to purchase the shares from the trust in DRM for $5 million. But then in 2008, Hanwha backed out of the deal. But at that point, Chet wanted to sell, so they continued marketing the business, and they sold to TransDigm for 95 million plus a potential 60 million around 2009. So the 2007 Chet option to purchase, exercising the option to purchase the shares from the trust and DRM was one of the issues that the IRS took issue with. They said that the 5 million was obviously below the fair market value of the shares at the time of the purchase, and the estate tried to use use the buy-sell pricing, the pricing from that agreement to fix the pricing for the estate tax. So the tax court opined that the comparability test is where those RPT agreements with the family trust and DRM failed. They said it was a bona fide business arrangement. The court opined that the agreement was meant to keep management control of the business within the family. They said it did meet the second requirement of 2703, which was it was not a device to transfer property for less than full adequate disclosure. Because even though it was only $2 a share, which was in 2007 well below what any fair market value estimate of the company would have been, the other good and valuable consideration was considered, and that was Chet taking significantly under market compensation for his leadership at the business. So that they passed that test, but then the comparability. They did not submit that Barneson agreement into evidence, and they tried to claim that the Barneson agreement was comparable. The court opinion said that, one, they couldn't consider the Barneson agreement because it was not entered into evidence, and then two, that agreement was the Barneson agreement was amended to allow Chet to purchase. The DRM and the Huffman Family Trust agreements were amended to allow Chet to purchase the shares from those two entities at any time for any purpose. whereas the Barneson agreement only gave Lloyd the right to purchase at the time of Barneson's death or under right of first refusal. So because of that difference, and Chet had more flexibility in when he could exercise the agreement, the court opined that even if they did submit that agreement to evidence, it would not have been considered comparable enough to pass this test. So basically, that's the big takeaway here is that this case just shows how hard it is to pass that comparability test, like Bo was saying. So, Bo, I don't know if you have anything to add to all that, but
No, I just echo that comment, Tom, as a practical matter, it's the comparability test that is always going to be the big hurdle. And that to me pushes towards evaluation-based methodology for buy-sell agreements.
yep. So with that, we'll take questions. I know we're pretty short on time. I think we're right at about an hour and 15. So I don't know. I guess let's take a look at real quick to see if we have any questions. And while we're waiting for questions, I just want to mention we will send the slides around. We'll send a replay of this webinar around to everyone who registered. And our founder at Mercer Capital, Chris Mercer, has written several books on buy-sell agreements. The one in the top in the middle is 2010 book, and we'll send an ebook around that has a lot more detail of some of the stuff we talked about up front, the pros and cons of the different pricing mechanisms and all the things that should be defined in an agreement. And then there's also a 2024 book, which you can purchase from AVA, the one on the top left. That one has some additional commentary on the Connelly case and some suggested language that you could use for the valuation sections of buy-sell agreements. But anyway, with that, let me see questions.
And Tom, I think our slides that we're going to share, we've got a more robust version than
we cut this down to make it fit the presentation, so we have a more robust version with more details. We can send the more robust version around. Yes. But I got one question I have here. Recommendations for funding buyouts when there is no life insurance and there's other triggering events. What do you have any additional thoughts there that we haven't covered?
Yeah, I mean, it's not uncommon that life insurance is, not practical economically for some business owners, or some business owners are uninsurable. And I think it always makes sense to include some sort of structured mechanism to fund the buy-sell agreement, whether that's, allowing seller financing over 5 years or 7 years, something like that, to create the flexibility to make the agreement work.
Yep. One more question that I see here, and I'm going to rephrase a little bit because this is something I'm curious about too. So I was talking before about the examples of life insurance as a funding vehicle if it's corporate owned or as a corporate asset. So obviously the Connelly ruling kind of said that it has to be, well, it kind of ruled that it was a corporate asset and you add the proceeds back. But I guess if there's an agreement that's being followed, unlike the Connelly case, the agreement's actually being followed, and the agreement for buy-sell pricing calls for it being viewed as a funding vehicle, so you don't add the proceeds from the life insurance in. If a case with that fact pattern came up, do you think the IRS would point to the Connelly case and say, no, you have to, for estate tax purposes, count the proceeds as in the corporate value, or would they say, well, you followed your agreement in this case, and so it's okay?
Yeah, I think I'll give you the ideal attorney answer, which is it depends. And if the agreement uses some sort of liquidation value based methodology, I think if you've got life insurance coming into the company, it's probably going to be factored in exactly the way the courts did it in Connelly, which it just adds to the value. Conversely, if it's a going concern based value, and Tom, this is probably more your area of expertise, but then it becomes a question of should an asset like life insurance really move the needle on the value, or is it going to be dictated more based on earnings, things like that. So if we've got an established methodology we're using for valuation, yes, it may factor in that life insurance policy to some extent, but I don't know that it'll just be a dollar for dollar increase if we meet the comparability test.
Yeah. There's probably a lot more we could talk about on that, but we're
Yeah.
out of time. So I guess if everyone listening, if you have any questions, you can definitely feel free to reach out to Bo or myself, and then also look for that follow-up communication with the slides, the replay, and that ebook that I mentioned. And thanks everyone for attending, and thank you, Bo.
Yeah, my pleasure. Thanks for having me, Tom.
Thank you so much for joining us today. If we were not able to address your question during our session, we will follow up with you individually. The recording of today's webinar will be available shortly, usually within the hour. You'll receive an email with a direct link, so keep an eye on your inbox. If you'd like to reach out with additional questions for Tom or Bo, please scan one of the QR codes on your screen to access their contact information or email them using the email addresses listed. CLE certificates will be emailed no later than Monday, April 27th. We appreciate your participation and hope you found today's discussion insightful and valuable. Keep an eye on your inbox for future webinars. Thanks again and have a wonderful rest of your day.